We're a value investor. We are long and we're short. At some point, we think the economy is slowing down, and we think that the Fed will have to adjust to that. My biggest concern is instability. Things are happening really, really quick, and it's a little disconcerting.
David Einhorn doesn't follow the crowd. He's earned his reputation as a value investor by making bold calls, not by chasing trends or timing the market.
Most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price, like what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value.
His strategy is rooted in deep research, finding undervalued companies to invest in and identifying the weak ones to short.
It leaves us sort of as a dinosaur. We're one of the remaining few people left who are looking at things on a traditional basis.
Einhorn didn't set out to become one of Wall Street's most recognized hedge fund managers. After graduating summa cum laude from Cornell in 1991, his plan was to study economics.
I applied to the top economics graduate schools, and they did me a huge favor by telling me, like, don't do this. Like, you're not accepted.
When that plan didn't work out, he pivoted. With some grit and a whole lot of persistence, Einhorn carved out a new path.
I interviewed anybody who would take a meeting with me, probably 40 or 50 different entities, and I wound up taking a job in investment banking because I thought the people would be the most fun to work with.
That move would eventually lead him to launch Greenlight Capital in 1996, a long-short hedge fund with just under $1 million in startup capital. A decade later, in 2007, he'd made one of his most famous calls, shorting Lehman Brothers just before its collapse. Einhorn's an avid poker player, and he says there's more overlap between the card table and the market than you might think.
You're dealing with knowledge that you have, like what are your cards, and then you have like things that you can infer, like what is the other person's behavior, and then you have the uncertainty of future outcomes.
When it comes to value investing, Einhorn says the key isn't just being right, it's knowing when you're wrong and taking responsibility for it.
If we do a really, really good job, we're gonna be right 65 or 70% of the time, which means we're gonna be wrong 30, 35% of the time. So we have to constantly be saying, are we wrong? And just own that. There's no shame in being wrong about something.
So tell us what Greenlight Capital actually does. Is it a value investor or is it some other type of investor?
Yes, we're a value investor. We are long and we're short, and we also make big picture macro investments as well. But our goal is to buy things that we think are undervalued and are likely to do well as a result of being undervalued. And we sell short things sometimes that we think are overvalued.
So value investing is when you're trying to buy something that you think is worth $1, but it's really being priced at 50 cents. In recent years, that's been difficult because of the Magnificent Seven and other technology-related things inflating the stock market, and for a long time there was low interest rates. So today, has value investing been a profitable thing to do over the last 10 years or so, or has it been hard to do?
The market structure has changed, and there has been what I consider it to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. The market is now dominated by passives, index funds, which buy what everyone else has already decided things that are worth, or algorithms, which are basically trying to figure out what is everybody else doing and how do I front run that, or retail, which is buying things because they think it's cool or they think it's going up. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price, Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur. We're one of the remaining few people left who are looking at things on a traditional basis.
So you're not necessarily trying to predict where the market's going to go with a particular stock. You're saying that this stock is so low in value that eventually somebody else will figure out that it's worth more, or the dividends alone will be enough to make it a worthwhile investment.
It's the latter. We think the dividends alone are going to make it worthwhile as an investment, or buybacks, which give us a bigger percentage of the company, are going to make it worthwhile investment. If other people figure it out and re-rate the shares, that's upside, but that's not our base expectation.
Okay, so the most famous value investor of them all is probably Warren Buffett. You would agree with that?
Of course, and the best.
So he made stock investments as you do, but he eventually started buying companies and holding onto them and fixing them up and improving them in some ways, though with modest staff. Do you do that as well? Do you buy companies, or do you just buy stocks and then hope that they will go up or believe they will go up?
We buy securities, and our ideal holding time is not forever. Our holding period often does run into years, but we don't have a view of buying things to hold them forever.
Your organization is one that has researchers who are helping you research whether something is worth buying or worth shorting, right?
Yes.
And you typically buy equities only, or do you do debt?
We will do debt, but we buy debt when it's distressed or through bankruptcies. We tend to be cyclical participants in the debt market. There used to be this thing called credit cycle, where lots of companies would have bonds that you might think like paid off, and you could earn equity type returns with much less risk. And when that happens on an unlevered basis, we participate, but it's been a long time since we've had a genuine credit cycle.
So let's suppose I come to you and I say I would like to make an investment with you. I'd like to put money in in your funds or something. What do you think is an appropriate return for somebody investing in a value investing organization?
Well, we started in 1996, and our compounded return after fees is in the 13s. And after taxes, it's about 1% less than that.
As we talk, the tariff situation is still in flux a bit. The president imposing tariffs, getting rid of them for a while, maybe coming back. You have a view on whether tariffs are a good thing for the U.S. economy?
I think they're a regressive tax. They affect consumers as opposed to people based on how much income that they have. And so I think they are raise prices. If you bring in a tariff, maybe the supplier has to pay part of it, maybe the retailer has to pay part of it, but the consumer also has to pay part of it. So I think tariffs are a tax on lower income disproportionately, and I think that they have an inflationary impact, and I think they slow down the economy.
Are you worried about the U.S. economy generally, leaving the tariff issue aside? Do you think the U.S. economy is in reasonable shape, or do you think your worries about a recession?
We were in a slowdown even before Liberation Day, and that likely is continuing. Whether that slowdown amounts to what turns out to be a recession or not is something that we'll have to look back on. But the trajectory of the economy is clearly slower.
And do you worry about the fact that the U.S. has a gigantic budget deficit and a gigantic amount of overall debt, 36 trillion or so?
I've been enormously worried about this for a long time. In 2008, I came to the view that the U.S. policy and monetary and fiscal policy was just too aggressive, and we began buying gold. And we even created a gold-denominated class. So if you invest in our fund, you can invest in the dollar class or the gold-denominated class. I think that our monetary and fiscal policies haven't made sense for a very, very long time, and I think that ultimately that is something that's going to come out of the currency.
And do you worry about the value of the U.S. dollar? The dollar, some people say, might actually go down in value and be devalued, as we did with the Plaza Accords in 1985, or do you think the dollar is going to stay pretty much at the value it has?
Well, I think it's going to continue to depreciate versus gold. The other currencies also have their own issues with their own fiscal and monetary situations, but I think versus gold, I think the dollar will continue to depreciate. It has done so consistently.
How do you think the Fed has done in trying to deal with inflation? Do you think the Fed should have increased interest rates sooner and should decrease interest rates more rapidly now?
I don't know about increasing them sooner. I know when the inflation was happening after COVID, it was pretty obvious that there was a lot of inflation. We actually took a large position in addition to our gold in what are called inflation swaps which are basically a derivative on the actual realized inflation that we thought everybody was underestimating. It's been one of the more successful investments we've made over the last few years. I think the Fed was historically back then was too slow in dealing with the inflation. I see the policies that are being created right now as fundamentally inflationary, and so I think we're going to continue to have inflation.
But you would expect a few rate cuts this year. The Fed has implied that it might do some more rate cuts, but it hasn't actually said it would. Do you think the Fed will rate cut maybe 2 more times or so?
Our expectation is that there'll be more rate cuts than is priced into the forward curve at the moment this year. At some point, we think the economy is slowing down, and we think that the Fed will have to adjust to that.
Over the last 25 years or so, ever since China's been a member of the WTO, we have been in a really close economic relationship with China in the sense that we buy a lot of things from them and they buy a lot of treasury bills from us. There has been talk of a decoupling of our economy from China's. Do you think that's a wise thing to do, or do you think it's likely to happen?
It appears that the relationship is very frayed. That's just kind of the uncertainty that's there. I think that as a general matter, American policy of separating from other countries, we have this America First policy, which sometimes feels like America Solo policy. I don't think it's great for us. I think having allies is good for us. I think working with other countries is how we expand the wealth of the planet. And having trade tends to raise wealth in both directions. And so I think it's a problem that seems to be fraying at this point.
As you look at the investment environment, what would you say is the biggest concern you have? Look at the global situation, the U.S. situation. Your biggest concern about the investment environment today is what?
Well, sitting here today, my biggest concern is instability. And we're in a very volatile time, and there's a lot of decision making that's happening. Like, I'd like to tell everybody, if you like the news, wait 2 hours. And if you don't like the news, wait 2 hours. It'll change. Things are happening really, really quick, and it's a little disconcerting. I used that opportunity to really study Warren Buffett. So I read 2 or 3 biographies, I read all of his letters. I had really sort of built up a bit of a knowledge about him and his history and his process.
So the greatest value investor we mentioned is Warren Buffett. Have you ever met him?
I have.
And does he give you any
I was
words?
actually the first one to buy the lunch with Warren Buffett. He sells a lunch once a year.
What did it cost?
It cost about $250,000.
All right, so for $250,000, what do you get other than a hamburger or something? You got some pretty good words of advice?
I did. So I used that opportunity to really study Warren Buffett. So I read 2 or 3 biographies. I read all of his letters. I actually went out to his annual meeting and I watched that whole production go on. And so I had really sort of built up a bit of a knowledge about him and his history and his process. So I was ready to ask a lot of questions that seemed pertinent to me.
So let's talk about how you started it and talk about your background. Where were you born?
I was born in New York, but immediately moved to New Jersey, like from the hospital.
Okay.
I lived there till I was 7. My father worked for my grandfather in a paint business. And in 1974 or so, there was a big consolidation with the energy prices and the rest, and the family sold the paint business. And my dad started his own little M&A boutique.
Okay.
And Mom said, well, if you're just working yourself, why don't we move back to Milwaukee, where her family was from? And so we did. So in 1976, we moved to Milwaukee, and that's really where I grew up, in the suburbs.
All right, so you went to college where?
I went to Cornell. I majored in government.
I majored in that too, but I don't know how useful it was at the time.
I would agree with you. I don't think it was that useful, but it was very interesting to study. And my folks always said, just study whatever is interesting to you, and that's what I picked.
And what year did you graduate?
In 1991.
Okay, so you just said, I'm going to go in the investment world, or I'm going to go into government. What did you decide to do?
While I was at Cornell, I was in something called the Cornell and Washington program. And I worked at the SEC in the Office of Economic Analysis. And I worked with these professors who were essentially on leave doing economic research about markets and stuff like this. And I assisted them in some of their basic, diligence research to help them write their papers. And then I came to write my own thesis as part of my honors program at Cornell, and it was kind of like a political economy type of thesis, and I decided I really wanted to do economics. So I applied to the top economics graduate schools, and they did me a huge favor by telling me, like, don't do this. Like, you're not accepted. So I then did on-campus recruiting. I interviewed anybody who would take a meeting with me, probably 40 or 50 different entities. And I wound up taking a job in investment banking because I thought the people would be the most fun to work with.
So you went to investment banking. Where did you go specifically?
It was Donaldson, Lufkin, Jenrette.
That's a great firm. So what did you do there?
Well, I made photocopies. I supervised word processing. I helped books become assembled. I was an analyst. I was a grunt. I did whatever it was that they told me to do, and it was a tough experience.
Those programs are typically 2-year programs, maybe 3 in some cases. So after 2 or 3 years, did you stay or did you go somewhere else?
Yeah, after 2 years, I finished. I miraculously made it through the 2-year program. It was very, very hard for me. But I got a call from a headhunter towards the end of the program saying, would you like to work for a hedge fund? And I took the interview, and I liked the people, and so I took the job.
Which hedge fund was that?
It was called Siegler, Collier & Company. I was an analyst. So they would give me an idea and tell me to go figure it out, and then I would come to them with whatever I found and suggest we either buy it or don't buy it or whatnot, and then we would iterate on that process. They would tell me, well, what about these questions? And then I would go dig some more and try to get answers to things to help them manage their portfolio.
How many years did you do that?
I did that for 2 years.
And then you said, I'm ready to start my own firm?
Yeah, the guy on the who was maybe my age but a year further out of college than me knocked on my door one day and said, why don't we go out to lunch? And he said, why don't we start a hedge fund? And it sounded like a great idea to me. And 3 weeks later, we were out on the street trying to figure out how to launch what turned out to be Greenlight Capital.
Typically, for a hedge fund, you need to get 2 things off the ground. One is you have to get people. You had one partner, but you have to also get capital to run the firm and capital to invest. So where did you get that kind of capital?
Right. His responsibility was meeting with investors. We met with a large number of people, and nearly none of them invested. So we started in May of 1996 with a little bit under $1 million of outside money under management. Plus I put in a couple $100,000 of my own, and he put in a couple $100,000 of his. And so we started with about $1.3 million or $1.4 million total. And the smartest thing he ever said was, instead of waiting for the 10 million, which is what our initial marketing goal was, why don't we get going? And so we got started.
So you must have done reasonably well because more capital came in, is that right?
We did. We got off to just a really fabulous start. 1996 was a terrific time for what we were trying to do, and we made good decisions, and it just worked out great. We made like 37% the first 8 months, and then the next year we made something in the 50s, and we were just off to get going.
So you built out your research staff, I assume, to help you with some of the research. And were you the principal investment professional? You
Yes.
made all the investment calls?
Yes, I've been the portfolio manager the whole time.
And you have people under you now give you ideas, but you're still, no decisions made unless you make the decision, right?
Well, sometimes I defer to them a little bit because they've done all of this work. Even if I'm not fully convinced, sometimes we'll do stuff that other people think.
So today, do you actually seek money now, or now you're not in the money-seeking business, kind of comes in over the transom where you have as much as you want?
Yeah, we had a period where we were closed, which was really from 2000 or 2001 to 2019. So we were closed for the better part of 20 years. But we did have a rough period, and a lot of our investors did redeem. And sometime around 2021, we decided, let's see if we can repopulate the investor base. And so we've been in the process of doing that.
A rough period meant some of your deals didn't work out as well, or your returns went below your average?
It was just a really tough environment for what we were doing, and we hadn't figured out this revised market structure. I made one particularly bad investment in 2015, which turned out to be a fraud, and we lost a whole bunch of money. But 2018, it was just whatever we were doing, we didn't make money on anything, and we lost little bits up and down the entire portfolio. We have to constantly be saying, are we wrong? And just own that. There's no shame in being wrong about something.
You were well known for being, among your outside activities, being a poker player. So were you a young poker player as a kid, or when did you take up poker?
You know, growing up, we played all the games. My family was a game-playing family. We played games after dinner routinely. We played games on the weekends. We just played all of the games. So games has just always been a part of my life. And then I took off from all of this altogether. A few years after that, I went to a charity poker tournament, and I just had a great time. And I ran into a buddy, and he said, "You want to learn more about poker?" And I said, "Sure." And he gave me a couple books, and he invited me to his home game, and we just took up poker. About a year or two later, we decided, as a bucket list thing, let's go play in the World Series of Poker in Las Vegas. And so we just kind of went out and did that. I thought it would be like a one-time thing. And I had the luckiest run of card playing, that I'll ever experience in my life. And I finished 18th out of like 8,000 players. And from there on, I was just kind of hooked.
So I am not an experienced poker player, but if I were, would that help me be a better investor? In your view, does being a great poker player help you as an investor?
I actually think it works the other way. I think the investing helps me with the poker more than the poker helps with the investing. Poker is much more volatile than I would run my investment portfolio. So I think if you start as a poker player, you probably have too big of a risk appetite to be doing the kind of investing that we do. But some of the skills overlap. I mean, you're dealing with knowledge that you have, like what are your cards, and then you have like things that you can infer, like what is the other person's behavior, and then you have the uncertainty of future outcomes.
As you look at the investment business, is it a business that you would recommend young people go into?
My advice for young people, broadly speaking, is figure out where your strength is and pick a career that plays to your strong suit. So don't go into something that you're not naturally good at. Go into something where you're the most naturally good at, because whatever you're going to do is going to be competitive, and there's going to be other people who are going to try to do whatever it is better than you. So you may as well lead with whatever your strength is.
And you enjoy the business as much as when you first got into it, I assume?
Oh, I love this business.
And
otherwise, I wouldn't be here.
Who is the kind of person you like to hire? Is it somebody like you who's did really well in school, is a good head for numbers?
First of all, we like to hire people who are already experienced. So we don't really hire very many very young people. We're not hiring people out of undergraduate or out of banking programs like I was hired when I got into hedge funds. We're mostly hiring people who've at least done the job as analyst, if not portfolio manager, somewhere else. And then I'm looking for a philosophical alignment about how to go about investing, raw intelligence, critical thinking, and most importantly, somebody that I want to work with every day.
So for people that are watching and want to know what they should do with their money, let's suppose somebody said to you, I have $100,000, that's my money that I can afford to lose. What would you tell the average person to do with their money?
I think you should have a mix, and I think owning some stocks is good. I think having some cash or cash equivalents is good. I think owning some gold is good. I would mix it between those.
What is the best investment advice you've ever received?
The best advice I've ever received in managing the portfolio is, as soon as you know that you're wrong, change your mind.
And the most common mistake that you see investors making when they invest money is what?
The opposite of that. They stick to something even though they know that they're wrong. The minute it occurs to us that we've made a mistake, it's time to move on.
Does that happen very often, or now you do so much research you're pretty comfortable with
No,
that?
we make lots of mistakes, and we're wrong a lot. If we do a really, really good job, we're going to be right 65 or 70% of the time, which means we're going to be wrong 30, 35% of the time. So we have to constantly be saying, are we wrong? And just own that. There's no shame in being wrong about something.
Now, are your parents alive?
Yes.
And do they call you and say, we always knew you were going to be a famous hedge fund investor, or they don't say that?
No, I think the only people more surprised than me about my success are my parents.
Oh, really? What did they think you were going to be? A government analyst?
I don't know. My attitude in life has always been, you're doing this now, do it well. If you do it well, you'll figure out what you want to do next.